hello and Happy New Year to everyone. I hope you've all had a lovely break over the Christmas period and I wish you all the best moving into 2024. As always, the purpose of these videos is to give a brief overview on financial markets and give an update on any news that's coming out more recently. Unfortunately, we start off with some bad news in that as the new year begun, we've seen financial markets start very slowly, with the majority of markets starting with negative trends moving forward. The S&P 500, for example, was 1% lower in late trading on the first day back for the year, which contrasts to the end of 2023, where the market was actually at the brink of its all-time high. The FTSE 100 also saw a flat start to 2024 as UK factory slump dampens New Year spirits. The DAX has also started the year weaker after outperforming many of its peers in last year. Looking at the housing market, UK house prices actually are on the up, where Halifax has released the latest data on house prices. This has seen UK house prices rise for the third consecutive month in December to the highest level since March 2023. This really came about as the supply shortage of property sales has resulted in the prices of properties to increase. Further to this, the house price and PMI figures provide evidence that the increase in property prices is not just down to a shortage in supply, but the fact that property markets improving as mortgage rates are starting to fall and builders' sentiment rises. According to the data, average house prices increased by 1.1% last month and 1.7% last year. Further to this, UK construction activity reported its best reading in 4 months in December. So good news for anyone that's invested into property at the moment. Over to our cousins in the US, we have a US payroll announcement. The US non-farms payroll released their latest figures for December 2023, which has surprised investors. The US has reported unexpected strength in the jobs market for December, adding 216,000 jobs compared to the expectation of 173,000 in November. Good news for global markets. This for me really sends a warning shot across the bows for the Federal Reserve, who may not have been enthusiastic about cutting interest rates over the course of the year as many people had expected. As a result of this news, the S&P 500 for the last 9 weeks of the year rose 15% against 6% for the FTSE 100, which is the UK stock market. So this really boosted sentiment into financial markets. Further to this, unemployment rate in the US has remained flat in December 2023 at 2.7%. Looking back home towards the UK, we've obviously had the tax cuts announcements in regards to national insurance, so a welcomed reduction. The main national insurance rate now for employees is now being reduced from 12% to 10% on the 6th of January 2024. And of course, self-employed Class 2 national insurance contributions will also be scrapped in April, a change that's been in the pipeline since 2015. So on the surface, there's good news for workers, but it's not as easy to figure out from the headlines exactly how tax cuts like this affect you and I. Of course, lower national insurance contributions should mean you keep more of your earnings in 2024. However, it's important to consider these cuts in the context of previous announced tax rises, i.e. stealth taxes and wage growth. What this means in broader context is that in general, unfortunately, as the levels of taxation is rising due to the freezing of the personal allowances, so as we are earning more due to price inflation, wage inflation, then more and more people are being falling into the higher additional rate tax brackets due to the freezing of those tax allowances, tax bands. So for anyone earning over 50,270, you're going to be paying 40% in tax. Anyone earning above 125,140, you're going to be paying 45% in tax. So people therefore need to be aware of this so-called stealth tax and how it affects the amount you're earning each month. Governments, of course, like this so-called fiscal drag because it raises a lot of money for the public, for them to pay public debt. The OBI, for example, estimates that the fiscal drag will raise over 25 billion a year in 2027-28. So this is something to bear in mind as you listen to the so-called tax cuts being made by the government, because of course, if you're earning more, you're going to be going into more and more into those higher tax bands. More people are going to be falling into that tax trap. So what's happening this week? Well, the EU will announce the latest unemployment rate, meaning over in the US, they may report the NBA mortgage applications result today. Over to the UK, where we'll see the RIC Housing Market Survey released on Thursday, whilst the US will post their latest Consumer Price Index report. On Friday this week, UK investors will receive the latest gross domestic product figure as well. So some financial figures to look out for there in terms of the state of the overall economy and what's going on with employment rates. So just wanted to, as I say, give that brief overview and rundown. Of course, if you've got any questions in relation to what we've been speaking about today, or indeed wider topics in regards to financial markets, please feel free to get in touch. Thanks very much.